So this will be my last lesson for the semester. I hope you have enjoyed these and gotten some out of them. And unfortunately, we rushed through quite a bit in the units 3 and 4 because of the time constraints. But I'll leave the notes up for at least the summer. If I accidentally take them down, feel free to email me. But if you want to get a little bit of a head start on next year, if you're going off to university for accounting, then it might be worthwhile to look over some of the units and the chapters that we skipped over. 10 and 15 were all about liabilities. There's some really good information about bonds in there. If you've never covered that, would be useful. And for this week, the official lesson is simply going to be walking through these slides, chapter 16 and 17. We never really got into chapter 16, the cash flow statement, but I do want you to be aware because it is the last of the major financial statements that you might encounter. And so basically what it is, if you look at, I'm going to bring up Best Buy's annual report here. This is a bit of an old one. But the 5 major financial statements that you'll see in virtually every annual report. Of course, there's the balance sheet and the income statement, or what's more often called the statement of operations or statement of earnings. Okay, so this is Best Buy. You could see the balance sheet. Hopefully you got a pretty good sense of what a lot of these are. We didn't get into the liabilities, but they're not so difficult. Basically just understanding why you would accrue a liability or an income tax or something like that. And then, of course, now you know what the equity looks like. Excuse me. But skipping over the statement of earnings, the third one is a comprehensive income statement, which is for major multinational corporations that pretty much have more than one main business, like have subsidiary businesses. So you'll often see this, not always, because not every company has subsidiaries just yet, but most of the major ones that you would study, publicly traded companies do. And this gives you just a general idea of some additional things that come into the company that are basically claimed by the shareholders of Best Buy. So, any subsidiary, non-controlling interest, foreign currency. We don't get into that. It's very convoluted. But the last, we did talk a little bit briefly about the statement of shareholders' equity, which basically tracks the changes that have happened to equity over the year, whether it's from dividends distributed or whether it's from stocks being sold, etc. The fifth one, the last major statement, is the cash flow statement. And basically what this does is shows you the change in cash from the beginning of the year to the end of the year. And more specifically, where the cash is going. It's very, very useful because remember that cash and revenue are not the same thing. So even if you're making a good net income, doesn't necessarily mean you're managing your cash flow properly. And essentially what the cash flow does, and you can read through the slides if you like, there are 3 sections. The first one is operating activities, and that gives me a sense of how the company is doing overall. Anything that's positive means money coming in. Anything that's negative means money going out. So in this case, you can see Best Buy has money coming in, $1 billion roughly, of cash from their operating activities. Of course, that's what you want. You want your normal day-to-day business to be bringing in money. So that's pretty good. The other 2 are a little bit unclear if you don't get to know them well. Investing activities is basically not investing in the sense of stocks and bonds, but more in the sense of PPE, as well as stocks and bonds. So you can see purchase of investments, sales of investments. Basically, is the company putting money into buying property and equipment? Is it selling property and equipment? What's happening? And you can see that they have a net cash outflow. A negative means an outflow. So they're putting a lot of cash into buying either property, as you can see up here, or other investments. So they're using their cash to invest, which is good, but obviously we don't want them to do that a whole lot. We'd rather they were buying more equipment to expand, more property, etc. The last one is financing. This has to do with things like dividends, paying dividends, selling stock, which is issuance of common stock, etc. And we can see that the biggest event this year was paying off the dividends, which is good as a shareholder. I'm happy with Best Buy paying dividends. You can see that over the last 2 years, they paid off a whole lot of debt, which is probably a good thing. So that's basically what the cash flow statement does. Basically tells me not just how my cash has changed, because I can see that on the balance sheet, but why it's changing, where specifically my money is going. Creating this is a god-awful thing, and you will learn how to create a cash flow statement. There's actually, I think, 2 or 3 different methods, but I don't cover that. It really is ugliness defined. So we kind of skip over how to actually create it, more just focus on how to read it. The last thing, and this is actually a review a little bit of the whole the whole semester, as well as last semester, or grade 11, excuse me. Financial statement analysis. So you already did some of this. You did the horizontal and vertical last year. We touched on the ratio last year as well as throughout. So basically, this just gives you an idea of how to analyze the statements. And then the trick, of course, is to really go over and try to see exactly what's going on. We haven't really touched on that. What we've been doing this whole semester in terms of those ratio analysis that I've been asking you to do is more or less step 1 and 2. Interpreting the numbers you've calculated for the ratios, comparing, contrasting with competitors, as well as previous years, okay? But true financial analysis is not just stopping there, but asking yourself, why? Why is my cash down? Well, why would cash be down? Because I'm making less money? Well, then you would look to the income statement to see if that's true. Is it because I'm buying new equipment? Well, then you would look to equipment or the cash flow statement to see if that's true. So this step is really the critical next step in a financial analysis, which is start making connections between all those little line items and ratios that you calculate. And once you do that, you get a really comprehensive view. This is where you can start to see, oh yeah, this company is losing money, but that's because they were investing heavily in new equipment, which is good for the business, and I think they're going to be doing well. Okay. Of course, the final step is to make a judgment based on all of those, to kind of combine all of these. And this is where you get different financial advice from. Some people might say Apple is doing wonderfully. Some people might say they're doing well. Some might say they're not doing well. Well, because you have so many different variables on all the different financial statements, I might interpret them slightly differently. Or in other words, the numbers are the same, but I might put more emphasis on a downturn in revenue, whereas you put more emphasis on a positive upturn in inventory management, for example. So just to give you an introduction to that, and hopefully that'll get you a little bit prepared for next year. Good luck.